Let's turn to my next guest, who is a buyer of short-term bonds here, but is warning you do need to stay diversified, especially if the Fed begins to cut rates as early as next year. Here on set with me is Michael Cuggino. He is president and portfolio manager of the Permanent Portfolio family of funds. First of all, Michael, welcome. I think it's the first time since COVID you've been back here. So,
pre-COVID, 2019.
Yes, we appreciate it. Yep. You don't have to get into the R-star, like all of these econ geeky things, but I guess they all come back to this question, which the 10-year is kind of pressing upon us today, which is, where are interest rates really headed, and what would your investment advice be?
Well, I think they're likely going to be higher for longer, roughly where we are. I mean, I think the big question that we haven't really talked about yet is the timing. The Fed wants 2%, somebody else says 3%, great, but when? And are they willing to raise rates to a point to choke off economic growth, which we seem to be having, to get to 2% quicker rather than later? I don't know the answer to that question, but that's a legitimate one. And so, for investors, I think this is all interesting. If you're a very conservative investor, you have your CDs at 5%, 4.5%. You don't have to do much. We think you can do better through a diversified portfolio.
Yeah.
If you have conviction in equities, there's certainly arguments to be made there. There's been a great stock market. And equities do have some competition for bond yields right now.
It feels like a strange world where we can make the case for both bonds and equities at the same time. But maybe it's just the flip side of what happened in the 2010s, where you could also bonds and equities at the same time, just, again, for different reasons today, I guess.
We've been doing the seesaw thing all year between bond investors and equity investors. The equity investor sees the Fed being done or close to it. Multiples are good. They're reasonable. There's the excitement of AI and all these growth stories out there. And so that's why equities have bled up, because there's been an absence of real negative news.
Do you think multiples are reasonable, though? Because they seem high by historical standards, not least. And this is the part I don't understand the most about this whole thing. They seem to be high relative to interest rates. It's so odd that we'd say we're going to go from 0 to 5 and the stock market multiple is going to go up and be near its historical highs. That seems so strange to me.
The broad market multiple is no longer as cheap as it was, no question. But there are definitely some opportunities that are below market multiples. I think energy, natural resources, real estate investment trusts. I mean, now you have to have a strong stomach to do that, but there are opportunities there. The bond investor sees tightening credit. It sees an inverted yield curve. It sees the Fed saying that they might have to raise more quickly and a recession. And that's that seesaw battle that we're having, and it tends to change on headline risk week to week, really.
Well, let me maybe ask a question differently. So for those who in the past kind of owned bonds but traded stocks, should you do the opposite now, where you own stocks but you trade bonds, right? The yields being as high as they are feels kind of like an opportunity to pick up some extra cash. I don't know how far out on the curve you'd go, but it doesn't feel like anyone really wants to say, oh yeah, I want to own bonds for the long run here. It's more just, does this feel like the kind of moment to strike while the iron's still hot, depending on what happens next year?
Well, this gets to the investor that was buying equities for yield several years ago, right? They no longer have to do that. And so they have to be a true equity investor to want equities. When you look at the comparable yields between, let's say, earnings on the S&P 500 and bond yields right now, if you're a growth investor, you're going to look at that and say, well, they're comparable, but I like the growth perspective and the long-term nature of growth, so I'm going to weight it that way.
Right.
If you're more conservative or you have liquidity needs going the other way, you take your 4 or 5% and short duration, and you go with that until you have more clarity.
Right, although it's not that tax efficient, but what do you do about that piece of it? It is what it is. You get what you get.
Great point. Dividends are more tax efficient than interest income.
Yeah. So for the person who might be more interested in that, they can tilt that way. So you mentioned energy, you mentioned REITs, but you also have some stocks in particular that jump out to you here. What are they and why?
Well, on the equity side, we tend to invest in a broad array of stocks, right? There's some growth. There's some what people would consider value-oriented names. I mean, some names that we like on the growth side are obviously in the tech area. Semiconductors, we think they're rich. NVIDIA, we own that. It's rich. I don't know if I'd buy it now, but on a longer-term pullback, I probably would, because I think it's a longer-term story. Broadcom's another name we own that's trading at a much more reasonable level, still a little high based on maybe the market multiple, but another great growth story there. Then we've got energy, something like a Chevron, a big diversified energy story. Freeport-McMoRan, which is a copper play, which we think is really still undervalued in the long term. And that company tends to you know, when copper prices go up, the money drops to the bottom line. Dividend yields go up, special dividends go up, and we think that that broader story is a multi-year one.
You could almost argue it's a copper gold play, and I can't let you leave without mentioning gold. And I don't know how big, you know, we're talking, like, what is it? I haven't paid attention lately, but gold kind of just sitting around these levels.
Well, it's come off its highs, and I think rightfully so, given the uncertainty of the interest rate environment and the strength of the dollar. The dollar has been very, very high lately, and that tends to put the dampers on gold. Our view in the long term is that it's going to be more valuable years from now than right now. I think the dollar is at a high. It's going to come off from that globally at some point. The Fed at some point is going to stop raising rates and likely will cut if there's a recession issue out there. Those are bullish for gold, and gold tends to do pretty well if you have a recessionary environment for many of those reasons.
All right, a little bit of everything.
Absolutely.
Michael, thanks so much. We appreciate it today.
Thanks, Kelly.
Michael Cuggino with the Permanent Portfolio.